2022 has had a ton of different changes, including interest rates, mortgage rates jumping up quite a bit. In fact, it's one of the only times in history that our mortgage rates have doubled within a year's period. So let's look forward to what 2023 is going to bring for us. My name's Miles Pitcher. I'm the owner of Superior Lending. In this video, these are the questions that I want to get answered for you. What will mortgage rates do in 23? Will there be a recession? Will there be a housing market crash? Will there be a bunch of foreclosures? And really, should you wait to buy a home or buy it now? So at the end, I hope to have all those questions clearly answered for you. So let's start out. If you've watched any of my videos, you know that mortgage rates very much follow what inflation does. So as inflation has risen up, so has the mortgage rate. And in this chart, you can see that. I'll make this bigger. So the pink or coral line is the consumer price index, or what the inflation rate is. And this is what the Federal Reserve watches. This part in here that talks about the QE period, or quantitative easing, that was a time period where the Federal Reserve was buying mortgage-backed securities and artificially keeping mortgage rates low. They have stopped doing that now, so our rates have jumped up because of that, and you can see that they are somewhat moving along with where the inflation rates are. You can see, and I'll show you more info here in a minute, that the inflation rates have started to curb or crest, and therefore the mortgage rates have done the same thing also. This is a month to month on what inflation core CPI looks like. And the ones that are in yellow, you can see, are the months that have passed over a year ago. And then the ones in white are just the last 12 months. The sum of those is what makes up the core CPI number. And you can see in the most recent months, our readings are coming in lower and lower, while a year ago they were much higher, and those are starting to drop off. This is another factor showing that inflation is better. Our year-over-year readings are going to continue to be better in there. So one of the other things that I want you to be aware of is that in every single mortgage that there is a servicing premium built in. And just think about it right now. Rates are higher, and most lenders or servicing companies believe that rates are going to come down in the next year. And with that, they know that these loans that they're currently servicing right now will most likely refinance. And therefore, they're not going to keep the loan for very long. So this is why you can see in this middle of this graphic here that today the rates are higher than they should be because of that servicing problem, that they know that people are most likely going to be refinancing. If we can get that back down to normal ranges, you can see that our rates should be around 5.5%. All right, this is a chart that's moving along to speak of a recession. And the gray bars represent all the different times since 1984 or 85 that we've had recessions. And you can see that what happens, that big, thick line at zero represents going negative. And this is the 10-year minus the two-year and Treasury note. And every time that it has gone inverted or negative, a recession has followed. So it's been a perfect predictor, and we are very much negative on the inverted yield curve right now. So to the question, is a recession coming? Yes, it is. The old definition of 2 quarters of negative GDP is a little outdated. They've added some other definitions to be able to call or declare a recession, but we fully believe that next year we will be in a recession. Again, a couple of other signs here of what is going to bring a recession. You can look in the top chart, you can see that over the past few months, with inflation happening, people are still spending like normal, and consumer debt is skyrocketing. Then on the bottom chart, you can see that the personal savings rate, what they're keeping in the bank, is diminishing. These are additional things that are going to contribute to us moving into a recession. The other thing that I get questions about all the time is, is this going to lead to a massive crash like 2008 and 09? I want you to be aware and look at this. These are homeowners right here in this chart of people who own a home, they have a mortgage, and what percentage of their mortgage payment is covered by their disposable income. And you can see that we are still very, very low on those payments. So really, we are not in a bad spot for those who are current homeowners in trouble on being able to afford their payments. You'll hear in the news that foreclosures have spiked and they're up. Well, the truth is they did spike coming out of COVID, but if you look at the charts, we are near record lows on our foreclosures, and we believe that will continue being super low because people have so much equity in their homes. If they get in trouble because of the recession, they'll just turn around and should be able to sell their home. The other point I want to make about is the stability of our home prices. And a lot of this is just based on the supply and demand. With having a limited supply, obviously that helps hold or even makes the prices of the homes jump up. The news would tell you that our inventory levels have spiked up. They have gone up, but if you look at the chart on the left here, our months of inventory for home sales is still very low. The chart on the right shows a little more detail, and we're about 3.3 months of inventory. This is still a low inventory number. It's still very, very good, still in a good spot for us to be able to hold our home values. We do not have an excess of inventory available. And in fact, home builders have slowed down on building their homes or starting new homes. And this is just going to continue to make this problem of short inventory exacerbated. So I wanted to show you this chart because it shows kind of historically how many homes have been for sale. You can see that our numbers are still low compared to historical ones. And some of the info that goes in here also is that the current rate of the homeowners right now, the average current homeowners rate is 4% or less. So people are in a good spot. We're also seeing that people are aging in place. They're staying in their homes longer. And then the other piece is we have a massive group of millennials or Gen Zs that need to purchase a home, but they haven't done that quite yet. And so we're getting this whole demographic that's building and building and building, and they're going to need to buy a home here in the future. All of these things help protect us from any serious downside in our home values. We may have some softening in the values, but really not that much. This chart shows you exactly that we have come down slightly, down 2.5% in our home values. So we do not believe that there's going to be any crash of any sort in housing. So in summary, inflation is going to be coming down, and that's going to turn into lower mortgage rates in 2023. We will have some recession-like conditions. We could have a uptick in unemployment. We're going to see that happen. We know and believe the recession is coming. We believe that housing inventory is still very low. It is a great time to buy a home right now, especially with sellers giving you many different concessions to help you either buy down the rate or cover closing costs. We also believe and see experts predicting that we will have continued appreciation in home values, maybe not anything close to what we've had the past couple of years, but we should have some single-digit appreciation. And we believe by mid-2023, we will be down at the low fives on our mortgage interest rate, which is a fabulous rate and will actually give us a really nice balance in the market between people doing refinances, purchases, and selling homes. My name's Miles Pitcher. Let me know what you think. Do you agree with these things? These are what we believe will happen in 2023. Have a good one. We'll talk to you soon.